One of the first decisions you make as an investor is how much in stocks versus bonds. Now, that's driven by time horizon. A guy by the name of Harry Markowitz came up with this idea of the efficient frontier. He says everybody wants the highest return, the highest expected return they can get for the level of risk that they're willing to put up with. And he came up with ways of mixing large companies, small companies, in various areas of the market. But the first decision is stocks versus bonds. Now, let's say if I had a 10-year period of time before I was going to spend all of the money. I could put up to 100% of my portfolio in stocks and not have seen a 10-year period with a negative return. About the closest we ever came was during the Great Depression. Vast majority of 10-year periods, positive return. So that gives you an idea of how much I can put in stocks. Now, if I said, it's 6 to 9 years, I'm going to spend all of the money, I might need to introduce maybe 25% of the portfolio into bonds in that particular case. 75% stocks. If I said I'm going to spend it all in 3 to 5 years, now I've got to back off on stocks even more and go maybe to 50-50. If I'm going to spend all of the money in 1 to 3 years, I would put 75% bonds, 25% stocks. And that's the idea. Now, if it's an emergency fund and I may be spending all of the money in 6 months, then I need to stay cash because I can't even afford a 1-year period or a 2-year period with a negative return in that particular case. So that's the idea behind time horizon. Now you got a secondary type of a portfolio decision. If I'm taking an income right now, well, shoot, if I'm taking an income for the rest of my life, I don't need all of it back in 1 year, 5 years, 10 years. I need it to last the rest of my life. And that's a different asset mix decision. It might be anywhere from 50% stocks to 70% stocks, and that's a different video. But that's the idea behind time horizon investing.